Welcome to How Do I Prepare My Business for Tax Season. During today's conversation, we will be mainly referring to the Schedule C tax form, which is the profit and loss for businesses that are run by sole proprietors. Also, today's conversation is focused on both home and center-based childcare businesses. Please note that the review of your tax situation using the information contained within this guide is not a substitute for carefully selecting a qualified tax preparer and should not be used in place of legal or accounting advice when needed. During today's conversation, we will cover the following questions. How is my business taxed, and where do I start? What things should I be mindful of when preparing my taxes? How can I assess my past taxes and look for opportunities to prepare for next tax season? And what resources are available to me? Many people feel dread at the mere mention of the word taxes. For most individuals, looking back at financial records and trying to understand what amounts fall under the categories you need to report on is just not how you want to spend your spare time. You may feel anxious about starting the tax preparation process, or perhaps you feel worried about the possibility of receiving a large tax bill for the year. These feelings are valid and shared by many. While acknowledging those feelings, you can, however, reframe how you think of tax season and look at it as an opportunity for you as a small business owner to save money and head off the risk of future issues. In today's conversation, we'll discuss the importance of taking the time to prepare for your taxes. We'll discuss how to analyze your past tax return for opportunities to do better this year. And also, we will review a free resource that shares information to help you prepare for your annual tax filing. So you may be wondering, how does this work? Self-employed small business owners are subject to a 15.3% self-employment tax on their net earnings, which is the profit that remains after all of your expenses have been subtracted from all of your income. Additionally, you are still subject to your general income tax rate on that profit. The government, however, allows certain business-related expenses to be removed from the amount of money that the government considers as your taxable revenue. So think of proper tax preparation as the way for you to make sure that you're not paying the government more than your fair share in taxes. If you dedicate time and effort to properly documenting eligible business expenses, you can reduce the amount of money you pay in taxes. This preparation process requires thinking back on your expenses throughout the year and getting organized with your receipts and paid invoices. The eligible expenses that you can use to reduce your taxable income are referred to as deductions, which ultimately impact the amount of money that gets taxed and potentially the rate at which you're taxed. When you itemize your eligible expenses, you subtract these expenses from your revenue to obtain a new amount, which is then called your net profit, also known as your taxable revenue. This process is referred to as claiming deductions. The greater the sum of your deductions, the less of your net profit that's subject to tax. The bottom line is thoroughly itemizing your deductions in accordance with federal guidelines will help you to retain hard-earned dollars. As you can see in the table displayed, the total of your deductions reduces how much of your profit is subject to tax. In this example, annual revenues was $35,000. However, by claiming no deductions or by not listing any expenses, that also makes your net profit, which is subject to tax, $35,000. This makes your tax liability higher. Let's say you have the same $35,000 in annual revenue. However, you've claimed $5,000 in deductions as your expenses. This now makes your net profit $30,000, which would lower your tax liability. It is important, however, to be truthful in reporting your deductions. Trying to fudge your figures to get out of paying more money in taxes can end up being much more costly in the long run. Dishonestly inflating your deductions increases your chances of being selected for audits by the IRS. We'll discuss mitigating some risks of a tax audit later on in this conversation. So what about childcare business taxes specifically? The Luminary Evaluation Group analyzed 60 childcare businesses' federal tax returns from 2019. And some of the key findings from the study was that 83% of childcare providers who operate out of their home did not claim the business use of their home at all. In some cases, providers did not claim any expenses on their tax returns at all. Many providers were claiming certain business expenses, which can drastically increase chances of an expensive and time-consuming audit. And there were several common deductions that were often miscategorized or improperly calculated that, when present on your taxes, can raise an automated audit alert. So we will review each of these findings in a bit more detail in hopes that you could avoid these common pitfalls when you file your annual return. So first, there's the business use of home. Home-based childcare providers should claim the business use of their home on their taxes. To determine the percentage of your home that is used for business, you can find the percentage of time and space that you use your home for business purposes using what's called the time-space calculation. There is a helpful worksheet that can help you calculate after you've taken the time to determine the amount of square footage that you're using in your home for business, in addition to the time that you put in annually to run the business. You'll plug those figures into this helpful worksheet, which is linked in the written guide for tax prep. And then this percentage can be applied to expenses that are associated with your home, including your rent, mortgage, property taxes, mortgage interest, utilities, homeowners insurance, and other costs that you have that have a joint business and personal element to them. Insurance. Business-related insurance costs, such as liability insurance, can be claimed on your taxes, but this cannot include personal or health insurance. So understanding that childcare is a highly regulated industry and that most, if not all, childcare providers are required to have liability insurance, it's imperative that you claim that deduction because it's one that you do have or that you may have, just as a result of you being a childcare provider. And if you're paying that expense, be sure to deduct it. There's mortgage interest. For childcare programs that are not home-based, so a center-based property, mortgage interest for a business property that you own can be claimed as a deduction. When it comes to home-based providers, this mortgage interest cost or expense will already be captured in your business use of home calculation. So, in the case of a home-based provider, you would not want to include mortgage interest on that separate itemized line in addition to within your business use of home calculation. And when it comes to a non-home-based business, you can use the mortgage interest line item to claim those expenses. Supplies. Believe it or not, supplies were another commonly overlooked deduction. This can include classroom supplies, learning materials, toys, diapers, wipes, cleaning supplies, and any other supplies that you've purchased over the year to use for the rendering of childcare services. This is when organizing your receipts, tracking your receipts, and recording them throughout the year will really come in handy. That way you're not overlooking any expense that you may have had in this category. And then there's wages. Annual salaries and wages for W-2 employees and yourself, if you pay yourself through payroll, can be deducted on your taxes. But be sure that you're only claiming W-2 employee wages here. Wages paid to 1099 contractors cannot be claimed on this line. Please stay tuned for more resources on paying yourself as a sole proprietor and how to distinguish whether your staff should be classified as a contractor or an employee of the business. So again, any wages paid to 1099 contractors should not be claimed under the wages line item. It should be claimed under the contractor pay, which is line 11 on the Schedule C. Small businesses' tax returns receive more scrutiny from the IRS than ever before. Often businesses are selected for audit because there's some element of their tax forms that fall outside of a designated category or criteria set by the IRS, which then triggers an automatic flag. One example of this could be not reporting or misclassifying income received. With app-based payments such as Venmo and Zelle being a common method for what otherwise would be cash-based payments, it's important not to miss those when reporting your income. The IRS receives a copy of the amount that the vendor has paid out to you, and your business will receive a 1099-K, and you must report that income. But another common circumstance that can trigger an audit risk is when a deduction line appears to be misused. To reduce the chances that you'll be selected for IRS auditing, which is a time-consuming and sometimes costly process, ensure that you accurately calculate your deductions and that you add them to the correct line. The Luminary Evaluation Group found that the following deductions are frequently misused. So pay close attention to these as you itemize your own deductions. There's the cost of goods sold. Childcare businesses can very rarely use this line as it usually applies to retail and manufacturing businesses. This line refers to inventory that a business has on hand that they were unable to sell or get rid of. Using this line could trigger an IRS audit because this is not applicable to your business field, and the IRS is aware of that. Deductible meals. This line is intended for business-related meals, such as business dinners. For the average childcare provider, The deductible meals line will not be a sizable sum. Following its evaluation of child care providers' tax returns, the Luminary Evaluation Group hypothesized that providers might be using the deductible meals line for the cost of food served to children, in which that expense would actually fall under the supplies line. When a child care program reports a high dollar amount in the deductible meals line, it may appear as if you're trying to deduct all of your personal meals as a business expense, which would trigger that flag for an alert. And there's car and truck expenses. Car, van, and truck expenses are a great deduction as long as you're claiming the amounts used for business purposes. Make sure that you're following the IRS guidelines for these expenses. A great way to start preparing for this year's taxes is to look backwards at your last year's taxes. And you can easily assess your taxes by using the Confidence and Quality Tax Prep Rubric for child care providers. And there's 3 simple steps to using the rubric. First, you will get your tax return from last year, and we're going to focus again on the Schedule C tax form that's most commonly used by child care providers. Next, you'll go line by line using the rubric. This is a copy of the rubric here, which each line mirrors that of the Schedule C. And the way the rubric is set up is that it will show you or tell you whether this line or whatever line was commonly used by childcare businesses or not. And then also some helpful notes to help you assess whether that line is applicable to you and if you are indeed calculating it properly. You'll note where you can do better, and you'll share your findings with your tax preparer as you prepare for the current year's filing. There are resources to help you plan for your next tax filing. Whether you choose to prepare your taxes yourself or use a qualified tax professional, be sure to refer to the Confidence and Quality Tax Prep Rubric to make sure you're maximizing your deductions and minimizing your risks. The rubric is available at the website that you see displayed here, www.luminaryeval.com/tax-prep-rubric-2021. And you can also view the helpful 2021 taxes workbook by Homegrown Childcare. It's designed specifically for childcare providers, which are home-based. However, the guide contains useful information for any childcare business owner. It includes guidance for handling relief funding and taxes, including the PPP and what impact that may have on your taxes, and also tips on how to select a tax preparer. That workbook is available at the homegrownchildcare.org website. And for more help on preparing for taxes, please visit the VECF.org/ARPA website to find the written guide on tax preparation, in addition to how different relief funding impacts your taxes. There's also additional resources to help strengthen your business, which includes easy-to-read written guides, webinars, recorded tutorials, and more. You can also register for small group business coaching on this topic or other business topics by viewing the coaching calendar available at vecf.org/ARPA. Thank you.